Ladies and gentlemen, when we think about gold, we often think about safety, stability, and a timeless store of value. For thousands of years, gold has played that role. It doesn't default, it doesn't go bankrupt, and it doesn't rely on anyone's promise to pay. But when we evaluate whether gold is a good investment right now, we have to look at it through the lens of cycles, valuations, and opportunity costs. And at this particular moment, gold doesn't present the kind of attractive risk-return profile that many assume. When we look at gold, the first thing to recognize is that it is not a productive asset. That distinction is critical because productive assets like businesses, farms, or technologies generate cash flows and earnings over time. They create wealth by producing more than they consume. Gold does none of that. It just sits there. It doesn't pay interest. It doesn't pay dividends, and it doesn't grow with innovation or efficiency. What it does provide is a form of defense, a way to preserve value across time, especially when trust in financial systems weakens. But understanding that distinction between defense and growth is essential for judging whether gold is a good investment at any given moment. Think about it this way. If you own shares of a strong company, that company is working for you every day. It's producing goods or services, competing in the marketplace, and reinvesting profits into expansion. Over time, that productivity compounds and builds wealth. Gold, on the other hand, is inert. Its value comes entirely from the perception of scarcity, from historical trust, and from fear-based demand. When people are scared about inflation, debt crises, or currency debasement, they run to gold because it feels safe. That is why I call it a defensive asset. It doesn't go on offense to grow your wealth. It simply defends it when everything else is under attack. If you study the cycles of history, you'll see that gold performs well in very particular circumstances. When paper money is being printed excessively and losing purchasing power, gold tends to shine. When governments or central banks mismanage debt and people lose faith in financial institutions, gold becomes a refuge. But in times when economies are stable, when monetary policy is tight, when innovation is flourishing, and when productive assets are generating real returns, gold lags behind. That's because in those moments, people aren't desperate for defense. They're looking for offense, for opportunity. This is why it's so important to understand the mechanics behind asset pricing rather than just buying into a narrative. The narrative around gold is powerful. It has thousands of years of history as a store of value, but narratives don't create wealth. Productivity does. When you allocate your capital, you're making a choice about whether you want it to be compounding or simply holding value. And because gold doesn't compound, it should never be mistaken for something that will deliver long-term growth. Now, there are investors who see gold as timeless, and in some sense, they are right. If you had to flee across borders in a time of crisis, you'd rather hold gold than a stock certificate or a bond issued by a failing government. Gold is portable, universally recognized, and immune to default, but those extreme scenarios are not the norm. Most of the time, the world continues operating, businesses keep producing, and money continues to circulate. In those conditions, gold is a kind of dead weight compared to assets that actively generate returns. Consider what happens over long periods. A portfolio heavily weighted toward gold would protect against collapses, but it would also miss out on decades of compounding growth in equities, bonds, and other income-producing assets. The opportunity cost of holding too much gold is enormous because every dollar tied up in gold is a dollar that could have been working elsewhere. That is why it's better thought of as insurance rather than as an investment. Insurance doesn't make you rich. It prevents you from becoming poor in catastrophic circumstances. But you don't build wealth by overloading on insurance. You build it by putting most of your capital into productive, growth-oriented opportunities. The trap many investors fall into is confusing stability with growth. They think because gold has held value for thousands of years, it must be a good long-term investment. But holding value and compounding wealth are two different things. Holding value is defense, compounding wealth is offense. And just like in any competition, you need to know when to defend and when to attack. Right now, in a world of positive real interest rates and attractive alternatives, relying on gold as your core investment is like sitting on the sidelines while the game is being played. The prudent approach is balance. Having some gold makes sense as a defensive layer in a diversified portfolio, but to overweight it, to treat it as a primary engine of wealth, is to misunderstand its role. Gold is timeless, yes, but it is not productive, and wealth over the long term is created by productivity. When we think about why gold isn't performing well right now, one of the most important forces to look at is real interest rates. Real interest rates are the return you get from holding safe assets like government bonds after accounting for inflation. They are one of the most powerful drivers of capital flows and asset preferences in the world. And right now, they are positive, which changes the whole equation for gold. To understand this, let's step back. Investors are always making decisions based on relative attractiveness. Every dollar that flows into one asset is a dollar that is not flowing into another. So the question is not just, is gold a good investment? The real question is gold better than the alternatives available today? When real interest rates are negative, meaning inflation is eroding the value of money faster than bonds can pay you back, gold looks appealing because at least it holds its value. But when real interest rates are positive, safe government bonds suddenly become very attractive. They pay you a yield above inflation with little to no risk. In that environment, gold, which yields nothing, looks far less appealing. This is the situation we are in now. Central banks have raised interest rates aggressively to fight inflation. And while inflation hasn't disappeared, it has cooled from its peak. That combination has pushed real interest rates into positive territory. For an investor, that creates a compelling alternative to gold. You can hold short-term U.S. Treasuries and earn a yield that not only preserves your purchasing power, but grows it. And since these are backed by the government, the credit risk is minimal. So why would large pools of capital choose to sit in gold, which offers no income, when they can earn a risk-free return elsewhere? This simple trade-off explains a lot about why gold has been losing momentum. History gives us plenty of examples of this dynamic. Look at the 1980s, for instance. After the high inflation of the 1970s, central banks, led by the Federal Reserve, raised interest rates sharply. That drove real interest rates higher and triggered a long period where gold prices stagnated or declined. Investors could earn safe returns in bonds, and gold was no longer the hedge they needed. The cycle we are in today looks very similar. Central banks are again prioritizing inflation control, and in doing so, they are creating an environment that favors yield-generating assets over gold. Another way to think about this is in terms of opportunity cost. Every investment choice comes with an opportunity cost, the return you give up by not choosing something else. When real interest rates are negative, the opportunity cost of holding gold is low because bonds aren't paying you anything meaningful anyway. But when real interest rates are positive, the opportunity cost of holding gold becomes high. Every dollar you put into gold is a dollar you could have put into treasuries, earning 4 or 5% over time. That difference compounds into significant lost returns. That is why capital naturally flows away from gold in such environments. Now, of course, markets are forward-looking. Investors are always trying to anticipate what central banks will do next. If there were signs that interest rates would be cut aggressively and inflation would rise again, gold would likely become more attractive. But as of now, policymakers are signaling a commitment to keeping real rates positive until inflation is firmly under control. That stance keeps the pressure on gold. The broader point here is that we cannot view gold in isolation. Its attractiveness is always relative to what else is happening in the monetary system. Real interest rates are the anchor. And right now, that anchor is pulling capital away from gold. This doesn't mean gold has no role. It still serves as a hedge in extreme scenarios. But it does mean that overweighting gold at a time when real yields are positive is not a rational allocation of capital. Over time, the cycle will turn. Central banks will eventually shift from tightening to easing. Real rates will fall and gold will regain its appeal. That's the rhythm of history. But at this stage in the cycle, with positive real rates and attractive alternatives available, gold is on the losing side of the relative value equation. Investors who understand this dynamic avoid being trapped by outdated narratives and position themselves where the flow of money is actually going. Another reason why gold is not a particularly good investment right now is that much of the bullish case for it has already been priced in. Markets are forward-looking. They don't simply react to today's conditions. They anticipate tomorrow's. That means by the time a story about an asset becomes popular, much of the upside that comes from that story is often already captured in the price. Gold is a perfect example of this dynamic. Over the past few years, we've seen a tremendous surge of interest in gold. Investors around the world have been worried about inflation, about central banks printing unprecedented amounts of money, about record levels of government debt, and about geopolitical instability. Each of these concerns has driven capital into gold based on the idea that it would protect wealth in times of uncertainty. Those flows pushed the price of gold up significantly. And as more people bought in, the narrative became self-reinforcing. Gold is rising, therefore gold must be the safe place to be. But when an asset is already crowded, when investors have already positioned themselves heavily in it, the fuel that drives further gains runs low. This is what we mean when we say an asset is priced in. If most of the fear, uncertainty, and inflationary expectations are already reflected in the price of gold, then the marginal buyer has little reason to keep pushing it higher. Instead, it sets up a situation where the risk is skewed to the downside. If the world turns out even slightly better than the pessimists feared, if inflation moderates, if the financial system holds together, if the economy avoids collapse, then gold actually underperforms because it no longer has the panic-driven demand that lifted it. We've seen this before in market history. Take the global financial crisis of 2008, 2011. Gold surged as investors lost faith in banks, currencies, and governments. But as the system stabilized and central banks successfully reflated economies, gold's momentum broke down. It wasn't that gold suddenly lost its long-term role as a store of value. It was simply that the fear premium had been exhausted. Once the worst-case scenarios were off the table, there was no new driver to push it higher, and the price corrected. That same pattern can be seen today. In the last few years, investors anticipated runaway inflation and systemic crises. They bought gold as a hedge. But now inflation, while still elevated, has been moderating, and economies have been surprisingly resilient. Debt is still a long-term issue, but it hasn't triggered the collapse people expected. So the worst fears have not materialized, at least not yet, and that has left gold vulnerable. When positioning is one-sided, even a modest improvement in conditions can cause significant unwinding. The psychology of markets is also important here. People like to feel safe, and when an asset like gold is rising, it creates a bandwagon effect. But when everyone is already on the bandwagon, The only people left are potential sellers, not buyers. That's where we are with gold right now. The fear trade is crowded, and that crowding creates fragility. If sentiment shifts even slightly, the move out of gold can be sharp because there aren't enough new buyers to absorb the selling. This is why sophisticated investors don't just look at fundamentals. They also look at positioning. They ask who owns this asset and why. If the answer is that a large share of investors already own it because of the same narrative, then the asymmetry is poor. There's more downside risk than upside potential. Gold today fits that description. The story is old, the flows are already there, and the expectations are largely baked into the price. None of this means gold is worthless. It still has its role as a hedge against extreme outcomes. But when you evaluate it as an investment right now, it is important to recognize that much of the juice has already been squeezed out. Investors who buy gold today are not getting in early on a contrarian thesis. They are joining a crowded trade that has already played out much of its narrative. That's not where you want to put your money. If you are seeking asymmetry, the kind of balance where the upside is much greater than the downside. So the point here is not to dismiss gold, but to be clear-eyed about where it stands in the cycle. Fear has already been priced in. The buyers have already positioned. The narrative is already mainstream. That leaves little room for surprise on the upside and plenty of risk if conditions turn out even modestly better than the dire scenarios baked into the current price. And that in itself is why gold is not a particularly attractive investment at this moment. Another important force holding gold back today is the strength of the US dollar. Because gold is priced globally in dollars, its performance is heavily tied to currency dynamics. When the dollar strengthens, gold tends to weaken, not because gold itself has changed, but because it becomes more expensive in other currencies. And right now, the dollar is in one of those strengthening cycles that acts as a headwind for gold. To see why, you have to understand the way global capital flows work. Investors around the world are constantly deciding where to park their money. They look for safety, yield, and stability. The US dollar, for better or worse, remains the world's dominant reserve currency and safe haven. When uncertainty rises globally, or when the US central bank tightens monetary policy, capital tends to flow into dollar-denominated assets. That demand for dollars pushes the currency higher, and in turn, gold priced in dollars faces pressure. This is exactly the environment we're living in now. The Federal Reserve has raised interest rates significantly in its fight against inflation, and those higher rates have made U.S. assets more attractive relative to the rest of the world. Investors can earn higher yields by holding treasuries or dollar-denominated securities, and the relative strength of the U.S. economy compared to weaker global peers only reinforces the demand for dollars. That combination drives the dollar up and almost mechanically pushes gold down. The dynamic is particularly tough for international buyers of gold. Imagine you're a European or Japanese investor. When the dollar strengthens, the price of gold in your local currency rises. Even if the dollar price of gold is flat, that makes gold less affordable and reduces demand from those regions. Gold is, after all, a global market. If buyers outside the US step back because of unfavorable exchange rates, the overall demand picture softens, and that weighs on prices. History has shown us many cycles of this dollar-gold relationship. In periods when the dollar is weak, such as during times of loose U.S. monetary policy or fiscal stress, gold tends to do well because it benefits from global demand and the perception of currency debasement. But in periods when the dollar is strong, like the early 1980s or the mid-2010s, gold has struggled. The dollar strength simply overpowers the traditional narrative of gold as a hedge. The current cycle is tilted toward dollar strength, higher U.S. interest rates, relative weakness in Europe and China, and ongoing global uncertainty have all combined to funnel capital into dollar assets. This makes sense from an investor's perspective. If you can earn solid yields in the world's most liquid and trusted currency, why would you seek alternatives that carry no yield? Gold, in that equation, becomes the loser by default. It's also worth noting that the dollar is not just another currency. It is the backbone of the global financial system. Commodities are priced in it. Global trade is settled in it, and central banks hold it as reserves. This structural demand for dollars means that when the U.S. tightens policy, the ripple effects are amplified. Countries that borrow in dollars find themselves squeezed. Emerging markets feel pressure, and global investors instinctively move capital toward the perceived safety of the dollar. Each of these factors adds weight to the dollar and subtracts from gold. Of course, this dynamic is not permanent. The dollar has its cycles, and eventually when U.S. monetary policy loosens again, or when confidence in the dollar wanes due to excessive debt and deficits, gold will regain strength. But the point is about the here and now. At this stage of the cycle, the dollar's strength is a headwind that investors can't ignore. Betting on gold in a strong dollar environment is like swimming against the current. It can be done, but it takes far more effort and often ends in disappointment. This doesn't mean gold loses its role as insurance or its historical value. It simply means that right now, in the context of a tightening Federal Reserve and a strong U.S. dollar, the forces are aligned against it. Investors who recognize this dynamic can better understand why gold isn't performing and avoid the trap of thinking that long-term narratives override short-term mechanics. Narratives matter, but the mechanics of global capital flows matter more. And the mechanics today say that as long as the dollar remains strong, gold will struggle to gain ground. When thinking about gold, it's important to recognize its true role in a portfolio. Gold is not meant to be the core engine of wealth creation. It is not a compounding asset that grows through productivity. Its real function is insurance, a hedge against extreme outcomes. That distinction is critical because it clarifies why overweighting gold right now is unwise and why relying on it as a primary investment is a mistake. Insurance is something we all need, but we don't buy more of it than is necessary. You wouldn't put all of your money into fire insurance because while it protects you in the event of a fire, it doesn't generate value for you in the meantime. Gold plays the same role in the financial world. It can protect you when fiat currencies lose credibility, when inflation spirals out of control, or when the financial system suffers a breakdown. But in the long stretches of time, when those crises don't occur, gold just sits there, not working for you. The reason this matters now is because we are in a cycle that does not favor defensive assets as a core holding. Real interest rates are positive. Innovation is capturing investment flows, and the global system, while strained, is still functioning. In these conditions, allocating heavily to gold is essentially overpaying for insurance. You may not need right away. It creates an opportunity cost because the capital tied up in gold could be allocated to assets that generate real returns. Over years, that difference compounds into a major gap in wealth outcomes. If we step back and study history, we see that the biggest wealth builders were always tied to productivity. The Industrial Revolution, the rise of technology, the spread of global trade, all of these were waves of innovation that rewarded those who owned productive assets. Gold during those same times preserved value, but didn't multiply it. That is why it makes sense only as a secondary component of a portfolio, not the centerpiece. It can protect you against catastrophe, but it won't create prosperity. This isn't to dismiss the importance of gold. In times of systemic collapse, such as hyperinflation in Weimar Germany, or the breakdown of currencies in emerging markets, gold has preserved purchasing power when nothing else could. That's why it has lasted as a store of value for thousands of years. But these moments are the exceptions, not the norm. If you build your strategy entirely around exceptions, you miss the broader cycles of opportunity that create wealth in the first place. What's required is balance. A prudent investor holds a diversified mix of assets, some that are defensive, like gold, and some that are offensive, like equities or real estate. The mix changes with the cycle. When money is being printed aggressively and real rates are negative, it makes sense to lean more into gold. But when real rates are positive and capital is flowing into productive assets, it makes sense to reduce exposure to gold and allocate more toward growth. The key is not to cling to one narrative forever, but to adapt to the realities of the moment. Right now, the reality is that gold is not the best place for the majority of your capital. Yes, it may offer insurance against tail risks, but the price of that insurance is high given the opportunity cost. There are better alternatives for wealth creation in this environment. Gold should remain in the portfolio, but in moderation enough to provide protection against worst-case outcomes, but not so much that it drags down performance in normal times. The lesson here is simple, but powerful. Know the role of each asset you own. Don't expect insurance to do the work of growth, and don't confuse stability with productivity. Gold's strength is in protecting wealth, not building it. And at this point in the cycle, over-relying on that protection is not a wise allocation of resources. The future will bring times when gold's role becomes central again. But today is not that time. Today, the better path is to hold gold as a small but meaningful hedge, while focusing the bulk of capital on assets that can grow and compound. That balance is what preserves wealth across cycles and builds it over the long run.